Dear students, in our previous class, we had learned the first two categories of ratios. First was solvency ratios, and under solvency ratios, we had learned to calculate short-term solvency ratios and the long-term solvency ratios. In the second category of ratios, that is the activity or turnover ratios, we had learned to calculate four important types of the ratios, starting from the inventory turnover ratios, debtors or receivable turnover ratios, creditors or trade payables turnover ratio, and the working capital turnover ratio. We had also learned how to find out working capital turnover ratio in terms of the activity or turnover ratios. Now we will discuss the final category of ratios, that is the profitability ratios. Now first of all, understand what we mean by the profitability ratios. Profitability ratios are those ratios which are calculated in order to assess the profitability or earning capacity of the business. As you all know that profit is a very important element for any organization, so its calculation is also very essential. So with the help of profitability ratios, we are in position to frame our financial policies, and these ratios are used to assess or evaluate the profitability level and the earning capacity of the business. Now these ratios are very important as profitability is the measurement of the overall performance and efficiency of the management. Under profitability ratios, there are number of ratios are calculated with reference to the various variables of the financial statements. But there are four very important ratios which we will calculate here. Apart from these four ratios, two ratios are also very important, and out of these profitability ratios, every year generally one or two ratios being asked. So let's start understanding the profitability ratios. Dear students, all the profitability ratios are generally expressed in the percentage form. As I share with you that there are various ways in which the ratios can be expressed, starting from the simple or pure form, then we had the very important times form, then we had the fraction form, and then we had the percentage form. So generally profitability ratios, they are expressed in percentage form. But again, please understand that there is no hard and fast rule that these ratios must be present in the percentage form. These ratios may be presented in any other form which earlier I had shared with you, but generally percentage is calculated with reference to the profitability level or profitability ratios. So under this, the first very simple ratio which we calculate, that is the gross profit ratio. This ratio shows the relationship between the gross profit and the net sales. Dear students, understand net sales is also known as the net revenue from operations or net revenue from sales, because here the sales word is used as the revenue from operations. And when we say net, net here means that after deducting the returns. So net sales or net revenue from operation means total sales or total revenue from operations less very important element, that is returns. So this ratio shows a relationship between the gross profit and the net sales or net revenue from operations, multiplied by 100 if we want to calculate in percentage. If we does not want to calculate in percentage, we does not multiply with 100 and directly we will calculate. So this way we will calculate the gross profit ratio. This ratio indicates the margin of gross profit available on revenue from operation. Generally, a higher ratio indicates better profitability. Higher the ratio, more is the satisfactory financial position of the organization with reference to earning of the profits. Second ratio which we will calculate, that is called the operating ratio. Dear students, the second and third ratio had the more or less the same title or the meaning. See here, the second ratio say operating ratio, third ratio is operating profit ratio. There is only difference of one word in the term of the second and the third ratio. Second ratio say operating ratio. Third ratio say operating profit ratio. The difference lies only to the word profit here. So what the operating ratio is there, how it is different from operating profit ratio. Please understand, operating ratio is an expense ratio. I repeat here, operating ratio is an expense ratio which establishes relationship between the operating expenses and the revenue from operations or the net sale, while the operating profit ratio is a profitability ratio which shows the relationship between the operating profit and the net sales. So let's start understanding how these ratios are calculated. So first we will calculate the operating ratio. As I share with you that it shows the relationship between the operating cost and the net sales or net revenue from operations. I hope now you understood the term net sales or net revenue from operations. Now operating ratio here means the relationship between operating cost and the net sales or the net revenue from operations. Here the formula is given gross profit divided by net sales or net revenue from operation. Instead of the word gross profit here is given wrong. We have to use the word operating cost or the operating expenses. So operating ratio formula to calculate is operating expenses or operating cost divided by net sales or net revenue from operations, and if we want to express our answer in percentage, we have to multiply with 100. Now understand that what we mean by the operating cost or the operating expenses, because for net sales and net revenue we already know that it is the amount of sales. Now what operating cost is? Operating cost comprise two important elements. One is cost of revenue from operations and operating expenses. Now earlier you had also learned how to calculate cost of revenue from operations. There are two ways to calculate cost of revenue from operations. This is also known as cost of goods sold. So how it is calculated? Very simple. Sales minus gross profit or net revenue from operations minus gross profit result to the cost of revenue from operations or cost of goods sold. Coming to the second element, that is operating expenses. Operating expenses comprise two very important expenses, that is office and administration expenses and selling and distribution expenses, and also the general expenses. Basically the general expenses, they are the part of office and administration expenses, but we calculate them as a part independently also. So office and administration expenses, selling and distribution expenses, and the general expenses, they are the part of the operating expenses. So when we add the operating cost plus operating expenses, if you come across, you would find that cost of revenue from operation is a part of the trading account and operating expenses, they've been taken from profit and loss account. So when we add the total of this, the result will be the operating cost, and when it is divided with the net sales or net revenue from operations, then we will calculate the operating ratio. This ratio shows the relationship between operating expenses and the net revenue from operations or net sales. Now there are other formula to calculate operating cost. As I share with you that it is a combination of trading account as well as the profit and loss account debit side item. So we would find here that number of elements are given which are associated with the trading account and profit and loss account. So this way we calculate the operating ratio or operating expense ratio. Now it is very important to understand this ratio indicates the percentage of operating cost to the revenue from operation. Lower this ratio is there, better is the result. Suppose the operating ratio is 70%, which means that 70% is the operating expenses and 30% lies to the margin. Suppose in another case it is 85%, it means now the margin reduced from 30 to 15%. So it is not better as compared to the first calculation which we had did. So This way we will calculate the operating expense or operating cost or operating ratio. Let's calculate the third important ratio, that is called the operating profit ratio. Dear students, understand that this ratio is calculated with reference to the operating profits and divide by net sales or the net revenue from operations. In these ratios, we have divided the total variable with the net sales or the net revenue from operations. Now, operating profit here means the journal and the operating profit which is generally earned. Now, operating profit is more than to the gross profit, as well as it is less than the gross profit, but sometimes the other calculations are also done. So here again the formula given is wrong. It is mentioned here gross profit divided by net sales or net revenue from operations, but actually it is the operating profit divided by net sales or net revenue from operations. Now, how the operating profit is calculated? It is calculated in different ways. First option is net revenue from operations minus operating cost. Means sales minus operating cost, result will be the operating profit. So this way we calculate to this. Please understand that this is a profitability ratio. Now, when we have the other way to calculate it, operating profit is gross profit minus operating expenses. We all know operating expenses comprise two important types of the expenses: office and administration expenses, selling and distribution expenses, and also the general expenses. Now, if we deduct from gross profit the operating expenses, that is office and administration expenses, selling and distribution expenses, and most important item, general expenses, from gross profit, result will be the operating profit. And when this operating profit is divided with the net sales or net revenue from operation, result will be the operating profit ratio. Dear students, understand that the operating ratio as well as the operating profit ratio both indicates the total of 1, because operating ratio is an expense ratio, operating profit is a profit ratio. So the combination of both is 1, that is total 100. Now, important points relating to the operating profit ratio is this ratio indicates the margin of operating profits available on revenue from operations to cover non-operating expenses such as the indirect expenses and the financial expenses. Generally, a higher ratio indicates the better profitability. Higher the ratio, more and sound profitability ratio it is. And the result is operating ratio, that is expense ratio plus operating profit ratio is equal to 1. So this way we have learned to calculate the three first ratios, that is gross profit ratio, operating cost or operating ratio, operating profit ratio. I will continue in my next video relating to the other remaining profitability ratios.